Good evening, everyone. This is Sumit Singh, and I'm the managing director with Sumit Capital. We are a boutique firm based out of Ahmedabad. We are typically uh, deal into investment advisory, and I personally am a SEBI registered investment advisor. And of course, we are going to present uh, a case study or let's say study about how an investor can invest in the global markets to build an educational corpus. And from here, we are going to illustrate the platform, the Vested. So Vested is SEC registered investment advisors and the technology platform that we use for our curated portfolios. And so the illustration will give the idea to the investors why it is important for the investors to look beyond Indian markets, invest in international equity so that they can maximize their return and minimize the volatility that can come up with focusing on only one geography, which is India. So let's start with the presentation here. Uh, Over here, you can see the inflation rate for education in the US since 1980. And we are talking about private colleges, 4 year, typical 4 year kind of course that many students in India would opt for. So, in dollar terms, if a person who is in the US and who is investing in US, who that person will typically face inflation rate of 7.5%. Uh, and so in India, if you know that even in India, the inflation is very high, it's close to 8 to 10% for education. But the problem is if the Indian student aims to build a corpus uh, in the US college, and so since they are going to invest in the INR, their own currency, local currency, the effective inflation they will feel, there has been they're feeling for last 40 years, has been close to 11.35%, which is quite high. So this kind of inflation is unprecedented, and then we the parents will have to plan accordingly so that they understand that it's an uphill task and it has to be planned properly for the student to build a corpus for their comfortable education in the US. So there's a vast difference here, and we closely monitor this index called Higher Education Price Index, which has been published by a private firm, which speaks about the changes that is happening in the cost of education and how every year the line is getting steeper and steeper. So they also do the projection of what you can expect in the future. So all the parents who are serious about uh, sending their kids to education, this is a very helpful index. It should come very handy when it comes to understanding what inflation and what kind of corpus they need to build. The jump of the cost of education in the US, and even the living. So, so I think the best way to understand this thing is to give an example here. Let's assume that we are in sitting in January 2012. Um, and we have Mr. Chopra, a father, and his son, Arpit. So, what Mr. Chopra is planning is to send his son Arpit, who is 7 years old, to the US for his undergrad. And so that is like 10 years from now. And he will be needing the corpus in December 2021 for his 4 years course. And this is the thing he is working on. So going ahead, he would explore the websites of the colleges, and we are talking about January 2012. And he came up with the average cost, and the cost here would mean the tuition fees, the living expenses, the library fees, everything that encapsulates the education there. So he came up with this figure that he will have to build a corpus of $168,000 for him to have education for his son 10 years down the line, right? So 168 is a present cost, today's cost. And so at the prevailing inflation rate that time, which was close to 3%, he calculated that the amount that he will require in December 2021 would be close to $226,000. This is the corpus that he'll have to build. Now, Mr. Chopra has two options, and the first one is the most conventional one. The first one is to start investing in India in mutual funds, direct equities, PMSs, whatever, in INR terms. And after 10 years, when he is done with the building of corpus, then he will convert that corpus into the USD terms and then start the education for his son. So that is the more conventional way, and we'll try to understand why this is going to be more costly and more what do you call the things that he'll have to do more towards building his corpus. The second education, which is why we are here, is to invest the earned INR and invest into the US equity market by converting it into USD every period. It could be monthly or quarterly, but here we will take the case of monthly investment because we normally do the SIPs, systematic investment plans. So if he does that every month, converting INR into USD and investing into the US markets, these are two scenarios he will have in front of him. And so here's an illustration how if he invests in Indian markets, how the corpus will look, how the equity curve will grow, and for him to reach the amount of $226,000, he will have to invest 68,000 rupees every month. So this is what he will have to do. Versus investing in the US market, which would come down to 56,000 rupees per month. I mean, the corpus will be the same 206,000, but the difference is the amount that is needed, and this is the real-time data that have been taken since 12 to 21, 10 years data. So this is how this whole portfolio will fare up if they are investing with two different instruments. While there is a difference between a 14,000 rupees every month for 10 years to invest, what he will save up to is 15 lakh rupees, which he will not have to invest to build this corpus in 10 years, right? So that's how the difference would appear on the graph. So just to give you, yes, Bharat, yeah.
Yes, just to add, so on that graph, right, the major reason for a lot of savings for potential investors is because of the INR depreciation, right, that we've seen around 4 to 5% on a yearly basis. Rupee depreciates, meaning 10 years ago it would have been in the range of 40 to 50, correct, and now it's
Correct.
around 80. So automatically
80, yeah.
4 to 5% depreciation adds up, and why not start saving dollars right now? And you can and create a corpus, and set for your child education. That's what the major outcome is of this slide, right? Yeah.
Yes, absolutely. So we will illustrate two things over here. Why the INR depreciation is working against the Indian investors, and there has also been a bigger bull market in the US in last 10 years. But is it like anomaly or just like one time kind of thing from 12 to 20? That we'll find out. So we will have to explore different aspects over here. All right. So if you look at the performance of two portfolios in last 10 years, investing in Indian markets would yield 13% of return with a volatility of 16%. Volatility is an indicative of risk. More the volatility, more the risk the investor is taking. So it's like more drawdown for the investors. So we'll try to keep the volatility low and CAGR high. So investing in Indian markets would give you this kind of figure, and investing in the US market the US market after converting to from INR to USD will give you around 18 to 19% of return in last 10 years, and volatility much less than the Indian one. So there's a concept called risk-adjusted return. Like if you're taking more risk, you are supposed to get more return. That is the notion that we have in the financial markets. and that is been indicated by a ratio called Sharpe ratio. So higher the Sharpe ratio, better is the risk-adjusted return over here. So if you look at the Sharpe ratio for these two kind of investment vehicles, you will see there's stark difference that the US market have given the Sharpe ratio double as that of the Indian market. So for all means, you can see with this particular example that it has been the obvious one to go ahead with. But yeah, am I talking about one-off case like from Jan to 2012 to December 2021? I mean, it could be anything for any time period. But before that, we need to understand from the graph which Bharat was mentioning. So the green line is the performance of our Sensex Indian market index since last 10 years, and it has shown that in last 10 years it has gone from 18,000 to 62,000. And the red line is the depreciation of INR, which used to be around 54 and it is now 80. So while you see that in markets are going good, I mean, if you are earning in INR and you are spending in INR, you are perfectly okay. But if you are earning in INR and spending in the USD, then probably you'll have to face a lot of building up your investment process, because the depreciation has taken a lot, like 4% every year. So am I talking about the one-off case here? Let's talk about this thing. Now, these are like 5-year rolling returns between investing in INR and investing in the USD. The yellow one is the yellow one is the INR, and the blue one is the yellow one is the USD, and blue one is the INR. So rolling return means that at any point of time, if you invest and hold it for 5 years, and you plot it on the graph, so this is what you will see: the returns, blue versus the orange. And in last 5 years, we can see very clearly that most of the time, the returns of 5-year rolling period has been better for the US, investing in the US dollars than in the Indian market, Indian INR. It is evident to here, and we can also share the empirical study that we have done on the spreadsheet. And like, if you assume that now the prevailing education inflation rate is 4.63, and if you see the data points here, investing in USD has beaten the inflation most of the time, like all the time. But with INR, there have been cases when you could not beat the inflation, the return was so low. I mean, 90% of the time. So we established that returns in 5-year rolling period for USD has been much better. Now, talking about again the risk-adjusted return, USD versus INR, 96% of the times the Sharpe ratio has been better for USD than the INR. So even the absolute return and the Sharpe ratio both have been in favor of the USD. So, but we took the example of 10 years, right? So let's move to the 10 years one. In the 10 years of rolling period, like you're investing in 12, fetching the return in 21, or you're investing in 11, you're investing in 2002 and fetching this thing in 2012. All these data points shows that even in this case, 2 out of 3 times USD will beat the INR thing at the absolute return basis. And inflation, of course, this kind of long portfolios will always beat the inflation, so there was no problem with that. And the Sharpe ratio, 69% times USD did better than the INR. And that this phenomena has been very recent since the bull market started in US post the election of Trump in 16. So in absolute term as well, USD has been doing much better than INR, and that has the depreciation of INR has added to the performance as well. Right. So, but the thing is, if you invest all the amount in the equity market, whether it is Indian equity market or the USD, the US markets, is it prudent to keep everything in equity? And let's suppose if you start building your portfolio in 2011, And by the time you reach to 2020, you want to take the amount back to start your education, and the COVID crash happened, you will be left like with a very less kind of amount, and not the kind of thing, not the kind of corpus that you desired for. So over here, we have to understand the allocation of assets very well, and we have three categories over here: equity markets, we have debt markets, and we have inflation assets such as real estate and commodities. So equity markets typically grow because of economic growth. So we have once we decide to become a part of economic growth, then we fetch the higher returns, and across the market, across the geography, we all know that equities in long term does better than any other asset class. So typically for equity, we choose three kind of instruments: the US stocks, the developed market stocks. Developed markets would be like Western European countries, Japan, could be Australia, Canada. These are developed countries. And the emerging market stocks, which will be like typically like India, China, Brazil, Russia, South Africa, these kind of markets. Debt markets, it's like a bond. It gives you fixed return and everything. And so for this thing, we will choose three kind of instruments here: the US government bond, the US corporate bonds, and the emerging market bonds. And for inflation assets, we have commodities such as gold, silver, and we have real estate. So this asset class would help you understand how to mix your asset classes to reach to your goals, so that you can minimize your risk when you reach to your financial goals. So this table may look daunting, but let's just understand the essence of it. Let's look at the third column here. These are the asset class that I mentioned over here in the last slide. To the left of this third column, you will see expected return and expected volatility. Remember, we need to maximize a return, and we have to maximize return and minimize the volatility here. So you can see historically in last 30, 40 years, emerging markets have given the maximum kind of return on CAGR basis, but has also carried the highest volatility. And the government bonds with 3 to 4% have given the least return, but least volatility as well. On the right side of the third column, you will see a correlation factor between all this kind of assets. Now, without going into numbers, the thing you will have to understand, the greener shades that you see shows that there is a least correlation between the asset classes. So bonds and stocks do not go together. Same with bonds, the US bonds and the corporate bonds. So every asset class would have a correlation. That means when during the COVID crash, when the US markets or markets across the world were falling, there are a few assets who would sustain. Gold would go up, bonds will fall lesser. So these phenomena will give your portfolio much more stability, and which is required when you build a corpus for your education in the future. And how do we do that? Well, going back to the example of Mr. Chopra, on the x-axis, you can see years to fund, like the 10th year, like the first year when he will start building the corpus, he will use most of the equity part, less of the debt part. And as and when he moves towards his goal, up to the year zero, he will keep reducing his equity and keep increasing debt. So the time when he reaches his last year, like December 2021, he will have maximum corpus made up in debt, which is going to give him a lot of comfort. Of course, I mean the returns will be compromised, but at least you would know that you are near to your goal of building a corpus of $226,000 for your son's education. So you keep minimizing your risk as and when you go, but you have to give a lot of time for asset class like equity to perform. So that's why we started with a percentage of 80% here. Right, so that's the allocation that we use. It's a very typical example. It varies with each and every investor, but the essence is to have a flavor of all the asset class across all the geography for different time horizons, so that you can spread your risk here. And if you mix all these kind of asset classes and you get the returns, the historical returns risk, this is a efficient frontier. You will see the dot points over here, which represent a typical return of a portfolio with a typical volatility. So it is used for us to indicate where the investor falls in terms of how much risk he can take and how much returns he expect. So that is why dynamic process, we use it for the investors, and we try to make them understand why this would work and why he should take a risk only based on his risk profile and not something which is beyond his capabilities. So, while working with Vested, we built this portfolio called Global Balanced Portfolio, which typically has the asset mix of equity as 70%, debt as 20%, commodity 5%, illicit 5%. And this being a mix of all the asset class, if you see the difference of performance, while S&P has fallen 18% year till date, this portfolio has given a better return than the S&P for the same reason, because it has a mix of different asset classes and even the volatility is less. So we are planning to launch many more such kind of portfolios so that investors can jump from higher risk to lower risk according to steps, so that they understand that they are building a corpus from here to there. So you can visit our website and you can understand more about how this asset mix would work for you. And if you want, you can subscribe to it and start investing with as low as like 4 or 5,000 rupees to start with. So I think that's about from my side. I'm handing over this to you, but there's something we can talk about further from here.
Thanks, Sumit. I think that really captures what and why you built this portfolio, right? So quickly a brief about Vested. So we've been in the market for 4 years now. We have onboarded more than 250,000 users from India, meaning 2.5 lakh people have opened the US investing account with us, and now we kind of onboarding experts like Sumit and Sumit Capital to create their own vests, and it's a very beautifully structured and built. You should check it out. In fact, more than 2,000 of our users have shown interest to invest, in this particular portfolio as well. And what we want to do, we want to take this opportunity and show you a couple of the journeys here, meaning how can you subscribe to this vest and how can you actually create an SIP or a recurring investment in this vest. So I would ask Satyajit to take over, and he will quickly show you both the journeys here.
Yep. Thank you, Bharat. Thank you, Sumit. Let me share my screen, and I can quickly walk you all through how exactly you can have access to Sumit Capital Global Investing Portfolio and subscribe to it and invest it. I hope you all can view my screen.
Yes.
All right. So as Sumit was displaying on the PPT, the webinar to come to this particular website, the website link is vestedfinance.co/in/Sumit Capital. So once a person is there in this particular page, one can see how one can read about Sumit Capital. One can see a brief about Sumit Capital West, that is Global Balance Portfolio, and how one can have access to this particular platform. So it's a 3-step process. One is to create an account with Vested first, fund your account and get KYC approval and fund your account and invest in Sumit Capital West. So let us quickly go ahead and I can show you how we can have access to that particular platform. So there are four options wherein we can have access to the platform. One is sign in with email or use a social media account that can be Google, Facebook, or Apple ID. So once I have created, already have done the sign up, I can go to login process. I'll just log into one of my account. To set up this account, it will require just 5 to 10 minutes of your time at max, and you can set up your global investing account. As you can see on your screen, once you are logged in to the platform, you can see that start KYC process section is there. So you can just directly go ahead and start your KYC. As you can see, only two things is required. That is, one is your photo ID that you can use is as a PAN card, for example, and address proof that can be used. Your Aadhaar card can be used as address proof, and some information that is required. So overall, it will just take 5 to 10 minutes of your time, and one can open your, basically you can open your global investing account. You can see on this particular section, if you scroll down, you can see Zumit Capital Global Portfolio. We can check out 3 months, 1 month, and 1 week return. So this is basically, this graph shows a comparison between S&P 500, the index, and this particular portfolio. I'll just log in again using one of the approved account which I just quickly created, and I'll show you how I can subscribe to it basically. Use the same process, the process which I used to sign up for the account. Login, enter the PIN. So this is an additional step which is required once the account is approved, just to make the secure to your account. So I can go to the same section. As you can see, I'll just click on Sumit Capital Global Portfolio. Once I am on this page, as you can see, I need to subscribe to it to see the allocation, what exactly are there. And the other details are already visible, for example, returns and volatility. I'll just go ahead and subscribe to it. I can use any of the option. For example, as you can see on the screen, I can use pay via the UPI or card or net banking. And I am set to this particular portfolio. So once I have subscribed to it, I can see the allocation which are there in this particular portfolio. I can go ahead and click on buy. I can enter amount, any amount that I wish to invest in this. For example, let's say I want to invest $500. I'll click on preview order and place buy order. That's it. And I have subscribed it. I have invested to this particular portfolio. As we all know that currently the market is not open during this hour as we are speaking. So once the market gets live, this pending order will get executed automatically and it will invest in the market. So this is how the simple the particular platform has been, the vested platform has been designed in a way so that you can invest in an easier manner. Each and every details you can see from the platform itself. Under history, you can see all your transactions that you have been doing, trade confirmation statement, account statement, and also we help you with the tax document. So at the end of every financial year, you can get the tax document and file your taxes here in India. Yeah, that will be all for the platform demo. Any questions are there, we will be happy to address.
So, Satyajit, can you tell us more about the direct? What exactly is vested direct and the normal one? Or is it like mandatory for one to go ahead with the vested direct one?
Yeah, sure. So Sumit is asking about the transfer process. So basically, I can go to the transfer fund section.
Hmm.
I can click on add funds. As you can see, it will navigate me to the fund add fund section. So there are two types of process with which I can fund my account. One is I can proceed with vested direct account, or I can use my traditional bank account, let's say Axis Bank, ICICI, or HDFC, my existing bank account. So let's say I am proceeding with vested direct. So vested direct is an free INR savings bank account which is powered by State Bank of Mauritius, India, in partnership with Vested. So now what we have to offer here. So the benefit what we get with vested direct in comparison to traditional bank accounts is the first thing is deposit fee. Generally, typically, bank takes a deposit fee which is approximately 1500 rupees, you can see, and with vested direct it's zero. Secondly, the deposit speed is 1 to 5 days, which our traditional bank generally takes, and in case of vested direct it will be instantly. And we believe in transparency, so each and every process that starting from the setting up the account and doing the fund transfer, by which time the funds will reflect on your account, each and everything is transparent, and one can just open a vested direct account with just uh, giving their 5 to 10 minutes. It's very much simple. I just need to enter my mobile number, get an OTP, and enter the mobile number. Basically, enter the mobile number which is linked with Aadhaar, and the details will be fetched from my Aadhaar details, and I can easily open a vested direct account. It is as simple as it is.
Got it. Right. That was very helpful.
Yeah. Thank you.
So I think if we have any questions, then probably we can discuss here. Bharat.
So one thing, Sumit, you've been working in this industry for more than a decade, right? As you mentioned. I just had a personal question. So what made you look at this, right? US as an asset class as well, US markets too, especially for your clients. Can throw some light here, and then how you built your portfolio, a little bit more details or how you choose your stocks, and then how you've chosen these ETFs.
Right. So first thing is, for Indians, there is a lot of interest in the US markets. As US as a country, either it is for immigration or for the education or opening accounts just to mobilize their capital. So US has always been the favorite for Indians. What we've been trying to do is to uh, give them a channel wherein they understand how this investment can be done. Um, US belongs to developed market kind of basket. And for Indians, as an emerging market, the best bet, at least as of now, I mean, Europe, we all understand the sluggish economy the whole continent is going through, and there is no solace for them. Canada is still, when it comes to developed countries, Japan is going through their own problems and own stagnation. Australia and New Zealand, they are also one of the contenders for developed markets. But US, most of the technological advancement and innovations are happening in US, and uh, the USD has been, we all understand how dollar index has been outperforming versus all the currencies, which could be like one of thing. But for the exposure of the investor in developed market, US has to markets has to be there as as a as a best bet for themselves. So what how we are trying to do is to, for Indians who are more likely to go ahead with the mutual funds rather than building a direct kind of portfolio, The safer way to get invested in the developed markets like US is to go through ETFs, because ETFs is a basket. Basket gives you a lot of advantage towards minimizing a downside and participating in the growing market. So because we don't do this kind of intense research of individual stocks, so we want to bet with, and we all understand the ETF market is in the US. In the US is the largest in the world. They have ETFs for each and every theme, each and every strategy, and each and every kind of scenarios. Even they have contra ETFs wherein you can bet against the market. So ETFs was always there for us to understand, because most of the Indians who are risk averse would like to start with the least risk, and ETFs would give them this kind of risk, this kind of what do you call exposure. So when we came across investor and they wanted to know how to get exposure with the US market, I think that's when what we look in the ETFs is, I mean, again, that is very tactical, because if you are trying to build a long-term wealth, then probably investing in index ETFs is the best thing. And like, for example, if you belong to the IT sector in India and you understand innovation better, then probably you can look for a very thematic kind of portfolios in ETFs. So as and when we come across investors who have different kind of needs and different kind of things, then we try to build portfolio around this thing and offer them that this is what you can do. Uh, you can have exposure to US or Europe based on whatever you choose for, but you have to understand the purpose of the investment that you're doing, what financial goals they are offering to yourself. It should not be random in nature. It has to fulfill somewhere. So there are many qualitative and quantitative questions that we try to ask before recommending them where to go ahead with.
Fair enough. I think that helps. And one last thing from my side, I guess. So since it's so diversified, right, and especially you're using ETFs rather than individual stocks, which are a little risky, is this your portfolio suitable for all set of investors, all types of investors, or how do you recommend them investing in US markets and diversifying? And what should be the ideal time frame as well whenever someone is investing in your West?
Now, when we spoke about this portfolio, we clearly indicated that the portfolio, even though it is diversified geographically, but it still contains 70% of the equity. Now, for any equity of any market, for it to show performance, it need to have some time, and which normally would say 3 to 5 years for it to show its true colors. So any investor who is at least wanting to start investing, just test the waters in the US market, or the global market per se, should go ahead with this kind of thing. It should not be short term. You should not expect magic out of after 1 year that it will give you something. But yeah, but the thing is, every portfolio that you build has to be a part of the holistic picture that you build. I mean, you have investment in India, you have investment in India and equity markets, debt markets, and everything. Then you have a small portion of the global market, which you can understand how it will work and how it will serve your purpose in the future. So whether or not you are trying to exploit the USD for your child's education or something, if you still want to grow your wealth uh, with with lessening your volatility, I think global investment in my portfolio, the global balanced portfolio, would serve you better. But keep it for 3 years or 5 years.
Okay. No, nicely put, nicely put. I think that's it from my side. At least a couple of curious questions as an investor after I heard or saw the presentation. Satyajit or Peter, anything else you guys want to add?
Yeah, I believe we covered good points, and yeah, it's
Perfect.
good to know how basically I as an investor also I can create my corpus and invest.
We all should, we all should participate in see the thing that you are cooking, you have to taste it first, so
Correct.
you understand how it is going to fare up for yourself and your own investment. So we should all encourage that, and we all
Yeah,
do that.
absolutely. Correct. I agree. Well said. Well said. Okay. I think that's it, Sumit. Maybe we can end this for now. And thank you for joining, folks. Happy to chat and respond to any questions you guys have.
Sure. Thank you, Bharat. Thanks for your time. Thank you, Satyajit. It was a pleasure talking to you guys.
Thank you.
Yeah, pleasure. Thanks.
Bye.